Hey everybody, welcome to your weekend review for the week of Monday, October 17th, 2022, and oh, what a week it was. Got off to a good start this morning with UMBS 5.5 being up a quarter of a point real early, and it kind of stayed right around that range all day. Not much of a swing. It looks like 5 basis points off of that at one point in time, but nothing much, ending the day being up 30 basis points on the day. Yay, we got a win, which puts us right in the middle of that range, bordered by a ceiling of 99.54 and a floor of 96.984. It's a wide range, so we can expect some choppy activity and probably a lot of moves as the week goes on. We got word out of the UK earlier this morning that the new Treasury Secretary has a plan to walk back down their unfunded tax cuts, which really messed everything up about 3 weeks ago. European yields responded favorably. And an interesting stat, if the year ended today, it'd be the first time in history that both the stocks and the bonds were down over 10% on the year. Since World War II, only 2 years have both stocks and bonds declined at all over the course of the year. After both, there was a huge 18% and 25% drops in the 10-year yield in the year that follows. The New York Manufacturing Index fell to negative 9.1 from negative 1.5, twice as bad as expectations. This isn't a big market moving index, although when something is off by twice expectations, people pay attention and they go, hey, what's going on? So it looks like manufacturing is starting to chill out, which will have impacts on inflation. Fed President Bullard said over the weekend that he is in favor of a 3/4 of a point hike in November 2nd and the December 14th meetings. Also, Fed President Bostic is being investigated for making trades during their blackout period. For those that aren't familiar, they are not allowed to speak to press and the public in a certain amount of time before the Fed meetings. Apparently, he was trading base during those times. He says it was because he had a third-party money manager that did it, and he isn't involved with that, which seems tough, or the fact that you're a Fed president, you're not paying attention to your own money, makes you kind of wonder about your competency. Despite all the fears in the market, the residential mortgage-backed securities backed by non-QM loans have mirrored their agency counterparts, exhibiting low delinquency rate, which is really good for that sector and hopefully opening up some new possibilities and some new options for everybody to sell. Though life is not necessarily easy for all non-QM lenders. For example, this month, Angel Oak Mortgage, the publicly traded non-QM mortgage REIT, disclosed that it had received a 2-week extension on a financing facility it had with Barclays Bank. The new termination date is October 14th. The facility was negotiated a few days ago through AOMI subsidiary Peachtree Mortgage. So a lot of weird things happening over at Oaktree. They replaced their CEO and president, Robert Williams, not that long ago. So the sector is starting to do better, but not every company is the same. We also got news that Credit Suisse, whose stock dropped 50% recently on several different stories, has agreed to pay $495 million to settle a case related to mortgage-linked investments in the United States, reminding us that the 2008 financial crisis is still having repercussions. Yes, these are for loans made 15 years ago. So pay attention to your QC practices. Both the stock and the bond market had a favorable opening on Tuesday, with the UMBS 5.5 being up 30 basis points early, while stocks gained 75 points. The pound in the U.S. gilt weakened after the Bank of England denied a report. It's delaying its sale of government bonds until the markets are calmer. As the day went on, we had a sell-off in midday starting at about 11 o'clock, and then rallied a little bit back to be up 16 points net on the day. We have enough data now to add an extra technical resistance line on our graphs. As you can see, we now have a ceiling of 99.54 with a floor of 98.266, where we bounced off today before improving. So we had a sell-off that got us down to that floor, that technical resistance, which held, and things came back up to end the day up 16 basis points. Today, contracts on the S&P 500 climbed 2% after the underlying gauge closed above a key technical support level on Monday. The median price of the existing homes is now $400,000 compared to $314,000 back in January of 2021, which is a pretty big increase. The MOVE Index, which measures bond market volatility, has skyrocketed to its highest level since March of 2020. Was there anything going on unsettling in March of 2020? I don't remember anymore. Volatility has been 7 times more volatile in Bitcoin over the course of the last couple of months. The Fannie Mae Home Price Index had home prices rising 0.2% in the third quarter from the second quarter. That's up 13.2% year over year. That measure was 19% in the previous quarter. So homes are still appreciating at quite a rapid pace, though not appreciating at the same level that they were. Zumper released its national rent report, a ninth consecutive new high at $1,503 on average per apartment. Two-bedroom median rent is now $1,845. Industrial production also rose 0.4 in September, according to the Federal Reserve. July and August were revised downward. Capacity utilization rose to 80.3%. Interestingly, construction was a big contributor to the growth, increasing by 1.1%. So hopefully we can get some new houses out there. But you wouldn't know it from the builder confidence. Builder confidence continues to fall. Oh, if you've been listening to me for a while, you know I don't have a lot of sympathy for them. They're making money hand over fist and can't even build their product fast enough for all the demand. So I don't really want to hear about their confidence falling. It declined to 38, half of the level it was 6 months ago. Mortgage builder applications did fall 13% year over year, which is something, but it's down 13% versus some historically high numbers. MBS are now have enough data to have that technical level. Like we said, our ceiling is at 99.54. New floors emerged at 98.266, which has been holding. Today's exciting moments arrived after 11 a.m. when the bond market sold off somewhat sharply without a real satisfying explanation. Other news on the day: billionaire rapper and clothing mogul Kanye West, who legally changed his name to Ye, agreed yesterday to purchase social media platform Parler for an unknown sum. The news comes a week after both Instagram and Twitter restricted his accounts. Founded in 2018, Parler jumped in popularity after Facebook and Twitter banned former President Donald Trump in early 2021. Parler's parent company reportedly received $56 million in recent funding and pegs its monthly active users at roughly 700,000. For comparison, Twitter and Facebook report nearly 450 million and 3 billion monthly active users, respectively. We also got the MBA's performance reports, which showed that the fully loaded cost to originate a loan was now $10,937 in the second quarter. Ooh, that's a lot of money. And then we had a busy day on Wednesday. Rough open for bonds. They were down over a half point very early. We're down 41 basis points when we did our morning post. Stocks were down 20 points early. Pricing that day was in the toilet as bonds got slammed by overnight trading due to UK inflation. Their reading came in very high, and which started at 2 a.m. Eastern time. We got a new recent high on the 10-year debuting at 4.12, got all the way up to 4.12 in the morning. We had Minneapolis Fed President Neil Kashkari said that the Fed may need to push the Fed funds rate above 4.75 if core inflation keeps accelerating. This is along with accelerating UK inflation has put the kibosh on the two-day rally in bonds. Rising rates and home prices continue to depress housing starts. Starts are down 8.1% month over month and 7.7% year over year to a seasonally adjusted annual rate of 1.44 million. Not nearly enough. We need more. Building permits were up 1.4% month over month, so it is a slight spot of good news. Mortgage applications fell 4.5% as purchases fell 4% and refis fell 7%. This is the lowest level in 25 years. Ouch. Housing starts were down 8%, like we said, to 1.439 annual pace. 8% year over year. Zillow Home Price Index for September has values increased 14% year over year. Houses on the market 16 days. The 20-year bond auction in the afternoon came in at 4.395 versus an expectation of 4.370. The bid to cover was 2.5 versus a 2.65 average. Fairly weak results here. Continued the sell-off, ending the day down 70 basis points on the day. So a rough day all in all with lots of news coming out. This put us into a new range. We have that new floor at 98.266. While in China, Beijing was set to release its GDP data today. It was postponed indefinitely. Hours before the announcement, China's top planning agency said growth had rebounded significantly, and just take our word for it. Don't ask any other questions. That is what it is. Talk to you later. Don't talk to us. Bye. A deeper dive into the Fed minutes brought some good info. Tucked into the 12 dense pages described the Fed's September policy meeting last week. It was a statement concerning a seemingly innocuous yet vital estimate that the staff used as a building block for internal economic forecasts. Their gauge for U.S. potential output was revised down significantly, the minutes showed. due to disappointing productivity growth and slow gains in labor force participation. Potential gross domestic product is essentially an estimate of how fast the economy can run without breaking a sweat in the form of things like tightening resources and higher inflation. The new estimate was not disclosed. It was just said that it was significantly lower, which is interesting. We also got a post from our sponsor at wellthatmakesense.com. This is from the book Persuasion from the genius Robert Cialdini. This is all about front loading of attention for persuasion. So things you can do before actually trying to persuade somebody to make it more influential. On Thursday, MBS were flat as stocks gained early. The Philly Fed Index came in at negative 8.7 on a negative 5 forecast. It was 9.9 negative previously. Prices were up significantly. Employment was also up. Then we got another strong initial jobless claims. Only 214,000 people filed for first-time claims this week versus a 230,000 estimate and 226,000 the previous time. While trading in the first minute followed all the data to slightly stronger, traders logically turned their focus to inflation implications from the prices component of the Philly Fed data and the NFP anecdote from the employment component. St. Louis Fed President James Bullard said yesterday that he expects the Fed to end its front loading of aggressive rate hikes early next year. So which is basically saying to expect it to continue happening all year in their last two meetings this year and into next year. Meanwhile, the Beige Book indicated the economy is experiencing slight to modest growth, while inflation is showing some degree of moderation. The labor market appears to be loosening up with wage increases beginning to decline. The word recession actually appeared 13 times versus 10 times last month. Got more homes data. Existing home sales fell 1.5% in September to a seasonally adjusted average rate of 4.71 million. Year over year, sales are down a whopping 24%. The inventory of homes for sale declined as well to 1.25 million units. The median home price came in up 8.5% year over year to 384,800. Days on the market is 19, and 70% of properties sold within a month, which is pretty fast. We now have 3.2 months worth of inventory, which is about half of where it should be. More news out of Great Britain. The world's sixth biggest economy faces continued turmoil as the resignation of their Prime Minister Truss. She assumed the job just 44 days ago, making her the shortest-serving British Prime Minister, breaking the record of George Canning, who died after 119 days in office. This is especially weird because she was in office for 44 days, and for 10 of those, the government was actually shut down. So her replacement faces bond vigilantes' push to punish a lack of fiscal credibility, necessary and painful budget cuts, staggering political instability, and ongoing Brexit problems, and dismal growth. All in all, the day we ended up being down a total of 53 basis points on the day. That is not good. Broke through that floor at 98.266 and actually made a run for the new floor at 96.984. Tough day, tough consecutive days in the bond market. We also got another post from that brand new series at wellthatmakesense.com. This is that book Persuasion by Robert Cialdini, which is awesome. It talks about the trust is one of those qualities that leads to compliance with requests, provided that it has been planted before the request is made. This book and this series is all about things you can do to make people more influential before you are seeking to influence them. Then we had a bit of a better day on Friday, October 21st. Stocks and bonds were both flat on the open. News of the resignation of Liz Truss doesn't seem to have had an impact on UK assets as the pound and gilt continue to drop. 5-year Treasury exceeded 4.5% for the first time since 2017 in a global bond market sell-off. Rough, tough times in the bond market right now with all of the instability. This week shed light on housing industry that showed a slowdown in housing starts and existing home sales, as well as a decline in builder sentiment. Existing home sales data released yesterday showed that the sales have slowed to a 10-year low amidst higher interest rates. We also got news that the CFPB's funding arrangement has been ruled unconstitutional again by a federal appeals court. Elizabeth Warren's idea for the CFPB to have it funded by the Federal Reserve, which is outside the purview of Congress. This would make it impossible for Congress to cut its funding. This potentially could vacate some of the rulings by the Bureau in the past. I don't think it is anything that's going to affect the mortgage business that much. I believe that the actual litigation in question concerns payday lenders. We also got updated Fed funds futures. Fed fund futures are inching upwards again. The 75 basis point hike in 2 weeks is more or less a lock, and another hike in December has about a 60% chance. And yet another Fed president said he thinks more hikes are necessary. They really couldn't be more thorough in setting expectations this time around. We also got CoreLogic's report that rents increased 11% year over year in August. All in all, on the day, we ended up being up 36 basis points on the MBS 5.5, landing at 97.84 for the week, which kept us above that new floor at 96.984. Hopefully that holds up and we can turn things around next week, although we do have an awful lot of data coming in. So next week, not much on Monday to speak of, just some kind of secondary data. Tuesday, we get Case-Shiller Home Price Index as well as the FHFA. But we got a 2-year note auction that could move the market. Then we get a 2-year and 5-year note auction on Wednesday. Thursday, we get the ECB statement. With everything going on in the UK, could be very dicey. We also get the advanced GDP and a 7-year note auction. And then we get PCE, inflation, and consumer sentiment on Friday. That could be a rough day considering all of the different data that's coming in. Because we all need a laugh. The Onion. We love The Onion. Janet Yellen rolls up sleeves to take another crack at interrogating milk jug over rising food prices. If you need a good chuckle, which we all do nowadays, definitely check out The Onion. I should have that in our common sources and influences because it makes me chuckle a lot. But definitely check out thatmakesense.com for some great blog posts to learn some more things to try to help sell more regardless of your environment, as well as all the data from these places. And have a great and safe weekend.